Hello and welcome to ULI-Philadelphia. This is Emerging Trends in Real Estate 2008. In Podcast 3, we'll hear from a panel of housing experts with their outlook on the real estate economy.
We've talked about the housing market and what's going on here in relation to what's going on nationally and how we haven't seen some of the same excesses in the greater Philadelphia area compared to the U.S. as a whole. I'm going to ask Orwin to start and provide some overview.
So I would like to talk about 4 trends that we are seeing right now in the mortgage market. First of all, we see a massive shift away from private label or non-agency securitization towards agency securitization. Second, we see tighter lending standard, but in the prime segment of the market. Third, continue declining loan quality. And fourth, increased loan modification activity. Let me start with securitization. The subprime or financial crisis that started in late July have reduced appetite for risk for investors significantly. These global investors expect that more losses are coming into the residential market, and they think that financial institutions have not fully accounted for these losses to date. So there is very little or no securitization for subprime loans, Alt-A loans, stated income, and other non-traditional products. Okay, so basically these products right now are evaporating from the market. We also see some liquidity squeeze in the prime segment of the market, and those are the loans that lenders cannot sell to Freddie Mac or Fannie Mae, basically the jumbo market. The difficulty in securitizing jumbo loans can be reflected in the widening spread between jumbo mortgage rates and conforming rates. At the start of the crisis, we saw the spread to be about a full percentage point. Now the spread has been declining a bit to perhaps 50 to 60 basis points, but still the spread is much higher than historical average, which was about 15 to 20 basis points. So basically, if lenders want to originate these products that investors are shying away, those lenders will have to hold them in portfolio. And unless you are lenders with a big parent company, that's probably going to happen. So I think the trend that we are seeing now is a continuing declining share of private label MBS. The share peaked about over 55% around 2006, and it was estimated to be only about 25% in August of this year. We should look for the share of private label MBS to continue to decline, perhaps to even less than 20% by the end of this year. Will these risky products, can they come back into the market? Maybe they can come back to the market in the next year or two, but they have to be in a different version, have to be with significantly higher lending standards. For example, subprime ARM will have to be a hybrid ARM with longer reset period. Lenders would have to require now down payment. In other words, there will be no 100% or higher LTV loans. And the fact that investors shun away from these risky products have prompted lenders to tighten lending standards significantly. And we just saw some evidence. This Monday, the Federal Reserve released a survey of senior loan officers. And this is the first evidence that actually captured the behavior of these bank officers during the recent financial crisis, okay, because the survey covered the period July through September. In this survey, we saw continued increase in or more stringent standard in the subprime and non-traditional products. So that's nothing new. It has been going on and continue to go on. But the notable thing about this October survey was that banks, more and more banks now tighten lending standards in the prime market. Okay? The net percent of banks that tightened lending standards in the prime market was over 40%. And that compared to only about 15% in the previous survey in July. The segment that got significantly more stringent standard in the prime market, of course, is the jumbo market. When the Fed surveyed these bank officers and asked what kind of requirement that you start to tighten, what kind of lending standards that have been tightened, the officer said that we now require more down payment. We require more credit score, higher credit score for jumbo loans, and also we insist on full documentation of assets and income. So because of this tighter lending standard in a jumbo market, banks have seen significantly declining demand for jumbo loans now. According to this survey, over 50% of the banks saw declining demand in the jumbo loans. That compared to only about 10% in the previous survey. Although the increase or more stringent lending standards are necessary, the downside of that is that I think it's going to delay the recovery of the housing market. And also it's going to erode more of a credit quality because as more and more borrowers face reset, if they're in the jumbo market or if they're in a subprime segment of the market, they probably are not likely to be able to refi their way out of that loan like as easily as they had in the past. So in terms of credit quality, there are several surveys out there about delinquency and foreclosure, but the one I'm mentioning today is the survey by the Mortgage Bankers Association. And what we saw in the second quarter of this year is continued rising delinquency rates. And another thing is that the foreclosure start rate, the loan that going into foreclosure, actually rose to record high in this quarter, in this second quarter. The high delinquency rates, the top 5 states with the highest delinquency rates, continue to be concentrated in the Midwest or the South, where you have declining employment or slow employment growth or slow income growth. So that's continued to be the picture of the delinquency and foreclosure. But what has been driving the increase in foreclosure start, especially, and rising delinquency rate, is what's going on in these big 4 states, namely California, Florida, Nevada, and Arizona. These states had seen unusually high home price appreciation over the past several years. So what happened was these states also experienced relatively very high share of investors into the market. And because prices are high in these states, they also see a lot of share of ARM products. So many areas in these states are now seeing home prices decline. So that was the reason that we see a lot higher foreclosure rates and delinquency rates in these states. The record high foreclosure start that we are seeing in the second quarter is not a national phenomenon. Okay? Actually, 26 states saw declining in foreclosure start, and the rest of the states, except those 4, saw only modest increase in foreclosure start. So basically what's going on in these big states, California, Florida, they are the biggest and the second biggest in terms of number of loans. So what's going on in these states are driving the national average up. I think Gus mentioned a little bit about for local areas in terms of loan quality, relatively to the rest of the nation, loan quality in the local states are not as bad at all. Actually, Delaware and New Jersey have lower than average delinquency rate and foreclosure rates. For Pennsylvania, the delinquency rate and foreclosure rates are higher than the national average. But I think things are improving in a sense that the difference between the Pennsylvania delinquency rate and the national rate used to be quite high. It used to be over one full percentage point around 2002, and right now, since 2005, the difference between the national delinquency rate and Pennsylvania delinquency rate has narrowed significantly. So that's good news. And another comforting news is that Pennsylvania is among one of the states with the lowest arm share. So basically, that's not a whole lot of a risk factor there. I'm just going to close with loan modification. Basically, with foreclosure and delinquency rate, there are lagging indicators of the housing market. So because whenever we see the recovery in the housing market, we're not going to see the recovery in the loan performance yet. I think delinquency and foreclosures will continue to rise for quite some time. But one thing that's going on right now that it's pretty encouraging is the area of loan modification. We have seen a lot of activities in loan modification from a lot of lenders and our members. We're trying to do a study on that extent of the increase. But the study will come out later this year. But you can also look at reports from other big lenders. You know, for example, Countrywide announced a significant number of loans that are going through modification right now. And there are other programs also by FHA, by Freddie and Fannie that probably would allow many subprime borrowers to own FHA loan or own loans that could be sold to Freddie and Fannie. It comes with a price. You know, there's some requirement in there for loan to be modified. For example, you might have to meet certain LTV standard, or you have to be able to buy private mortgage insurance. So unfortunately, these programs or loan modification programs might help the better subprime or prime borrowers, but the subprime borrowers who are the most at risk of default will probably be helped by these programs. You know, if you are a subprime borrower facing a reset in a declining housing market, the loan probably will not be modified successfully. So that's basically the 4 trends that we are seeing right now in the mortgage market.
Jeff, Orwin talked about the increasing difficulty in getting loans, in particular jumbo loans and subprime loans, and that's been worsened even more over the past few months. Is that showing up? Are you finding that potential borrowers are having greater difficulty in obtaining a loan?
Oh, absolutely.
Okay, I'm sorry, to Jeff here.
We are not finding, two things. One, we do very little in the subprime business. In our backlog now, so maybe it is more difficult, but most of our product is not subprime. The jumbo, we are still able to get the jumbo mortgages, so I'm not finding that to be a problem.
Oh, okay. Because that's an area that we've seen and we've heard a lot about it, that people have not been able to obtain those, but that isn't what you're seeing.
No, people generally in the jumbo mortgages that have good credit, we are able to, more difficult to close. Lenders are, it's not as fluid as it used to be, but I believe that the jumbo mortgage business will come back in not a long time.
Okay, and in terms of the downturn that we're seeing in home building, I mean, obviously it's a very broad geographic area. There are all sorts of price points there. What areas are holding up particularly well or doing particularly poorly in terms of regionally or in terms of the type of home that you're trying to sell?
Well, the home building business is really dependent upon the location. We heard each market is very different. Even in Philadelphia region, the difference between Chester County and Burlington County is different. So across the country, where there were excessive inventories built, clearly nothing is selling. Arizona, there are still pockets in Phoenix. There are pockets in Orlando. But Florida in general is way overbuilt. We're building in Charlotte and Raleigh because it is an affordable. Nobody speaks with a southern accent. They're all from New Jersey there. But when you take what is selling, it depends upon the market. Our townhouses in this region right now are selling very well because two buyers, the first-time buyer can afford them. That's the more affordable product in the region, and the move-down buyers are buying them. But by and large, in this region, it's more about publicity and the fire sales. There is no excessive inventory in suburban residential real estate. So any product can sell, but we've actually pushed our prices up a little and given bigger discounts because everybody is afraid, and the fear in the market is the biggest problem. But there is no one product that we build that is not selling, but we do not do first-time buyer product in this region except for the townhouses.
Okay. And when do you see the home building bottoming out? I mean, and how do you see the market getting there?
It's going to be, again, in the regions in Florida where you are in Orlando, there's so much excess there, it's going to take some time. It's going to just take, it's not going to be over in a year, it's not going to be over maybe in 2 years in parts of Florida. In this region, it's really if people stay employed and if the headlines change and if we, the builders, quit advertising fire sales, there's no reason that this market won't stabilize within a reasonable period of time. North Carolina, our other big region, has the same thing. There is no excessive inventory. But if you go, we're in Chicago. Chicago looks like it's going to be a long, slow pull. So again, it's region by region. It's not, and market by market within the region.
Okay. I mean, are there any areas in the broader Philadelphia, Delaware, New Jersey area that you think are doing particularly well right now?
Oh, yeah, the better location. Our townhouses that are close to the main line are doing extremely well. What is not doing well, anything that's on the periphery, we were building $1 million houses probably where we shouldn't have been building $1 million houses. That, if they're not in good location, it's, again, location is so important. Some of those markets, we're having problems, but the better the location, the easier it is to sell.
Okay, great. And I'd like to switch now to Mitchell to talk about the rental market a little bit. In terms of what's going on there, how is the downturn in the housing market in this area, how is that impacting the rental market? What do you see conditions there looking like?
This is the greatest thing ever happened to us. We're happy for their pain. Jeffrey has caused me pain from 2001 to 2005 when they used to slip things under my tenants' doors and say, if you're paying $1,000 in rent, we'll lend you $200,000 in a mortgage with no money down. If you're paying $1,500 a month in rent, we'll lend you, $300,000 with no money down. And now we have what in our leasing applications is a foreclosure exemption, which they're coming back. Last week we had 1,500 applications in 33,000 units, and we had 50 people that had a foreclosure on their application. So we're thrilled with it, and it's helped our occupancies. It's a good thing. But I agree with Jeffrey. I think it's perception. I think from 2001 to 2005, people thought if they didn't move out of my apartment and they didn't buy that house, it was going to go up 10% every year for forever. And now they're afraid if they move out of my apartment and they buy one of his houses, it may go down 10% for the next couple of years. So I think it's a perception.
Okay.
But we're enjoying it.
Now, I mean, obviously it sounds like that there's a lot of very strong demand out there. What's going on with rents? Are you using the opportunity to increase rents?
Absolutely. Absolutely. Rents are going up. Concessions are non-existent. We are probably 96% occupied, 98% leased. We have no concessions whatsoever, except that every once in a while we'll have a unit type that we want to, concession, and we'll get it off our books. But rentals are very strong. Occupancies are great. We're seeing our turnover rate, which was it peaked as high as 45 to 50% in the peak of the housing market, has gone down to into the 30s. So we're seeing that very strong demand. And as long as the economy continues to be strong and job growth continues to be strong, we're going to be great. I find that sometimes if you drive around an apartment complex and you see out-of-town tags, that people are coming in for new jobs and then ultimately staying. And then it used to be they would come in from out of town, get a job, stay in my apartment for a year or two, and then move and buy one of his houses. Now they're staying an extra year, I think.
And again, are there any particular segments of the apartment market that you think are doing particularly well? Or are there particular parts of the region that are seeing very strong growth at the expense of other parts?
I think they're all really, right now, across the board, we're strong all across the board, from a empty nester senior housing to student housing.
Okay. And what about supply concerns? Are people putting up new apartments? Is that going to be an issue 2-3 years down the road, do you think?
I think the barriers of entry are so difficult in the markets in the Northeast that it's very difficult to build an apartment complex and make the economics work. Housing prices have gone down, but construction costs haven't gone down. Okay, land costs have gone down, but it's such an insignificant piece of the apartment valuation. So in suburban markets, we're not seeing any really new construction of multifamily. In Center City, we're seeing people that were building condos and now converting them to rentals. And I'd be curious to see how those numbers work.
Okay. I mean, are you concerned that those condo conversions are going to cause problems for you in a couple of years as those start
not
to come?
Not at $300,000-$400,000 a foot, no. Okay. Not $300,000-$400,000 a unit, $300 a foot, no. Okay. I mean, we just bought something in Cherry Hill for, $75 a foot. If you went in Cherry Hill and built in Cherry Hill and they gave you the ground for free, you're going to be in for a couple $100,000.
Mm-hmm. Yeah, I'd like to reemphasize what he's saying. That land is 10% of the cost of a house, 15%. Not the raw land. The improvement costs, of course, vary, but the building costs are not going down. So that's what's point is very valid.
Okay. And Susan, do you want to talk about some of the risks that you see for the regional housing market?
I think what I'll do is, if it's okay, step up here because I have some numbers which will be easier for me to actually read to be standing up. I'm going to give you some numbers nationally first and then talk about how vulnerable or immune we are. These numbers are really right on line with the trends that we heard from the Mortgage Banking Association. August sales are the lowest in the United States, new sales, that they've been for 6 years. Existing sales are the lowest that they've been for 8 years. Inventory is as high as it has been since 1988. So that's nationally. Housing prices are falling. Median house prices in the United States are down 7.5%. That's the not corrected. The corrected numbers for quality, the Case-Shiller index, is down 4%. So where does this take us? Where is the way out? Where is the light at the end of the tunnel? Where is the tunnel? Do we even know what part of the path we're in? Assuming that we have, and this isn't a big assumption, assuming that we do not have a national recession, that we only have what we have now, regional recessions, and I would say about 1/3 of the country is in a regional recession, although economy.com can give us more precise on that. Assuming we're not in a national recession right now, or we don't go into one, I think a consensus among economists, and again we have many here, is that we will be out of this sometime in 2009. But unfortunately, that's a big if. And my real concern, and it's a concern not only for the United States, but it's a concern we're not immune, as I will go to in a moment, for our region, is that this is not going to be a recession that's similar to the last recessions we've seen in the last 2 recessions. It's going to be more similar to the recession of the previous 25 years as opposed to the last 25 years. And that's because of the feedback effects. What we're talking about here is housing. But housing is much more linked, and financing of housing is much more linked to the overall economy than it has ever been before. So we have feedback effects. And I want to talk about those risks very briefly. But before I do that, I want to talk very briefly about why we're not immune in this region. We are better off. I don't doubt that. I think we're better off, although New Jersey is a little bit questionable, but Pennsylvania is better off. But we're not immune, first of all, because actually, contrary to what we might think, housing prices ran up in the Philadelphia metropolitan area more than in the U.S. So we're not Florida, we're not California, but since 1995, housing prices have more than doubled in the United States, and they've more than doubled, slightly more than doubled, in the Philadelphia metropolitan area. And in the city of Philadelphia, they've gone up 2.5 times. So we have much more vulnerability than the flatliners of the world, the Texas, for example, the Indiana. We are not as vulnerable, clearly, thank goodness, as the Californias and the Nevadas, Arizonas, and Floridas. The second point of vulnerability is, of course, New Jersey is more like California. It is exposed to the very high price increases. But focusing on the Philadelphia metropolitan area, the second problem is we are exposed in the city to subprime. And we've already seen a doubling of foreclosure rate in the subprime area in the city of Philadelphia. And we have already seen, as of this morning, in a release that's about to happen, housing prices falling in the city of Philadelphia. They've fallen 1% in the previous quarter. Not very dramatic, and it's not across the, it is actually across the board, which means it's not condo related, although I don't have the numbers. I will have the numbers later today on condos. I don't have those numbers there, but I don't think it's specifically condos. I think maybe even condos are so far okay. It's actually throughout the city that we've seen a price decline. So back to where the real risks are for us and for the nation as a whole. I'm an economist, so I am by nature a pessimist, so bear with me. Although I'm also on the one hand and the two hand as an economist. I always have to have two hands, so I will have something positive to say. And it won't just be the rental market, although I absolutely agree with the good news and the silver lining is the rental market. First of all, quickly, the feedback effects in housing. This is our piggy bank, which is not only empty, it's real broken. And if we have jobs, the exhausted consumer will be flat out in a sickbed. And we will really be in for it. Because we have become integrated, housing has fueled the up part of the cycle. It's incredible, 2000 to 2008, and it will indeed fuel the down as well. The second, people have said we don't have a crisis of a credit crisis. We have a crisis of confidence. Not true. Now, it was true. Now we have a credit crisis, as we heard earlier, in the banking sector, again through housing to the overall economy. The exposure, which we're just discovering now, the mistakes of investment banks are coming back to the commercial banks. Third, our old nemesis oil, to skip right beyond that, which is going to, along with the resetting arms, going to impact and is impacting consumers. But here is the real threat, and this is the integration not only, it's the integration of, ironically, the housing market to the international global market, which is pulling down the international global market, which is our real threat, is the dollar into interest rates. Now, right now, the dollar declining is helping us tremendously, and in this region specifically. But of course, if interest rates increase, all bets are off, and it may happen. The real bellwether of this is Fannie and Freddie's unprecedented 10% one-day decline yesterday. So I am concerned. Two positives. Besides whatever else, rental will do relatively well, and is already. But the other is, thankfully, the Fed is on the case. I see another decline in the Fed rate. Thank you.
Jeff, Susan brought up the possibility of more Federal Reserve rate cuts. Do you think that would be helpful for you in the industry?
Oh, absolutely. Of course, there's different ways to look at it. Some people say that Greenspan left the rates low for too long, and some, like myself, believe that they were raised too quickly, too fast. So lower rates certainly help.
Okay. I mean, since the Fed has moved in recent months, have you seen a pickup in demand, at least on the ARM side, or?
No, what it really does is gives the buyer some confidence. People, 2 months ago, August, September, were afraid what would the rates be. Now they believe that there's somebody behind control so that the rates will be affordable.
Okay. In Orwin, I guess one question with the Fed cuts, has there been a shift away from fixed rate mortgages to adjustable rate mortgages with short-term rates coming down, or is it just still frozen and not much going on there?
Not much going on in the ARM market. If you look at our survey of applications, the ARM share of application has been declining and remaining at low level, even if with a rate cut.
Okay. And do you think that there's a possibility that could turn around if the Fed cuts more, or do you think it's stuck there for now?
Yeah, absolutely. I think that will spur some activity in the ARM a little bit more.
Okay.
Support for the prime market.
One more thing is if rates do come down, more of these people will be able to reset, which would be a big help right there.
Yeah, that of course assumes that that the banks are actually willing to lend to them, which is the big question I think out there. The rate cuts are good, but the banks actually have to be willing to lend to them, so that may be an issue too.
And will they do almost this no money down loans? I mean, that's been the killer. I mean,
But that's not going to happen.
Yeah.
no,
That's
good. I mean, I'm good for me, not good for everyone else. But I mean, it's when I bought my first house, you had to put down a real deposit. And I went from almost no deposit, and I think it's going to shift back to a real deposit somewhere, in that range, which will make the barrier of entry in the housing market. It would prolong the recovery, in my opinion.
Mm-hmm.
Sure.
Okay. With that, I'd be happy to open the floor to for questions.
I have a question regarding interest rates. I think Susan hit on it briefly. Yesterday, the papers reported that the Chinese were thinking of trading out of the dollar because of the weakness and going into the euro. With the continued trade deficit that we have and the deficit spending that continues, it's likely that we will no longer be in control over our interest rates. Could you comment on that?
Certainly. That's the real risk related to the exchange rate devaluation. We can control short-run rates, but the real problem, and we already have the term structure, in fact, going back to normal, high rates on the long end. And after all, the mortgage market, especially today, is really being supported by the long-term fixed-rate mortgage, the conforming Fannie-Freddie product. That's what's at risk. You're absolutely right. So we really do have to watch what happens to the dollar, precipitous decline. We have to watch what's happening in China and Europe. The good news is they really can't create a run on the dollar because they own so much of the dollar right now. So they're equally at risk.
Yeah, I would just like to reiterate that point, that it's not in China's interest to see, to see interest rates fall in the U.S. because that just reduces the value of their holdings here. So
The dollar fall.
Yeah, I'm sorry. I think we're going to continue to see a slight weakening in the dollar, particularly against Asian currencies. But I don't expect to see foreign investors to move en masse out of the U.S. So I think that it's a possibility. I don't see it as a high probability event, but it certainly could have very negative ramifications for the economy and for the housing market if it does happen, but I don't expect it to happen.
Question for Mr. Orleans. Given the current inventory of unsold houses and various lots and stages of approval and improvement, what's your current land buying strategy?
Well, we're trying to sell the dogs and buy additional property that other people are either, one, being forced to sell. We are looking for excellent terms. 2 years ago, 3 years ago, everything we bought is underwater. Everything we bought 4 or 5 years ago is doing well. But the market is going back to terms. and terms is a builder's best friend. Buy 10 lots down and 10 lots next year, or whatever the terms are, where it's going completely away from all cash.
Question for the economists. Regardless of what the Fed does, you're seeing credit default swaps increase with the threat of recession. So long rates drop, that's not really going to affect mortgage rates. Any thoughts on that?
Well, my concern is not long rates. I mean, my concern is long rates going up. My other related concern is the subprime premium, which right now has moderated. As we heard, it's twice what it has been historically or more. It's about 50, 60 basis points over prime, over conforming, so the subprime mortgage is about. That could widen further. I'm concerned both at the long rate, the fixed rate mortgage overall, the treasuries overall, as well as the premium, both the risk premium on the subprime. That is quite volatile.
Yeah, and I would also add again the concern about the jumbo mortgages.
That's what I meant. I meant jumbo.
Okay.
I'm sorry.
That's the concern about jumbo mortgages, and that's a significant piece of demand out there. And if either spreads are high or jumbo loans simply aren't available because lenders aren't willing to undertake that risk, then that's a serious concern for the housing market, and that could mean a longer downturn.
And I'm sorry, I said something. I meant jumbo, and that's actually a particular risk for New Jersey.
What do you think the impact of the proposed development in Atlantic City and the proposed expansion of PATCO mass transit is going to have to housing in South Jersey?
We need our Jim Hous. Is Jim still here? He would be able to answer that in a minute. Maybe I'm the closest at it, having had a conversation with Jim. I think it's a very good thing for South Jersey. I think, and South Jersey might hold up better than in any case because it's more affordable.
I think that's right. I mean, there are problems along the coast in New Jersey, but that's largely because of demand for second homes. But I think, as Jim said, that South Jersey is still quite affordable, and I certainly think that if anything that makes it easier to live in South Jersey that improves quality of life, that's going to be a plus for the housing market over the long run once it works its way through the current problems. Great. Well, thank you very much. I appreciate it. All right. Well, thank you, Sue.
Well, thanks very much.
We hope you enjoyed this Urban Land Institute podcast recording. If you have comments or suggestions about these podcasts, please email steve@professionalpodcasts.com. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey. For the Urban Land Institute, this is Steve Lubetkin. Thanks for being with us, and take good care.